React to Mario Draghi's set of policy announcements and forward guidance today, and the idea that we're still only looking at, a modicum extra of inflation by 2021, even with all of these measures.
It's actually pretty sad to see for a few reasons. Number one, all this is doing is putting treasuries in Europe and around the globe at further negative rates. You have 17 trillion treasuries trading at negative returns, which is crazy town. Number one. Number two is doing nothing to stimulate aggregate demand. And so look at Germany, for instance, slipping into a recession or at least zero growth, UK slowing as well, and much of Europe mired in what is a very slow economic environment here. And number three, the equity markets, in terms of aggregate demand and what it does to earnings, is not responding either. Look at the DAX, for instance, trading at 13 multiple. And so we think that this is nothing more than further financial repression, a way of governments around the world able to borrow at very negative rates to finance their big deficits, and it be a tax on savings.
So how do you think about corporate Europe in that kind of environment then? Is it investable? These zombie companies that are getting, more and more money for less and less interest, can they continue?
All this does is create more of a debt bubble. It just allows companies to borrow at very cheap rates, and it does nothing to stimulate aggregate demand. And so we think it's a monetary trap that's being created, and it's actually a very healthy unhealthy environment that's being created. And so for the time being, the markets are stable, the markets will do well, but at some point, it creates this big Hunger Games. Where does one with capital go to earn an attractive rate of return when you have, trillions and trillions of treasuries and more trillions by the month trading more negative returns?
Over-leveraged, unprofitable businesses, lack of aggregate demand. Are there opportunities for you?
There are. We're not investing much in Europe because of how overpriced both debt and equity markets are based upon where treasuries are. Having said that, the biggest place of opportunity for us in Europe is our continued activity in buying non-performing loans from the European banks. And we're capitalizing off of these very low rates. Because Euribor rates are negative, we can borrow at Euribor plus a spread and have the lowest financing rates in the world. Meanwhile, take real estate through buying non-performing loans from the banks in Europe. We bought 3 packages over the summer, and we're in the process of buying another 3 packages between now and year end. And we're buying hundreds of millions, and we've bought billions of these non-performing loans that results in us owning real estate financed at the lowest rates in the world. So the spread between where we can finance versus the cap rates and NOI that we're earning on these assets is unprecedented.
The banks, though, did get a dig from Mario Draghi. He said, you guys have a lot more problems. We're giving you the tiering, you can have to.
It's helpful for the banks because they trade at a discount to their net asset value, and they should be trading at much higher premiums, but their yields are negative. And so it's hard for them to earn an attractive rate of return. It's also hard for them to make loans when aggregate loan demand isn't so great in Europe because growth is stymied.
So what happens to the banking sector itself in Europe, Bruce, and why are you so confident? I mean, we're seeing trouble with banks in Germany. Obviously, Italy and Spain are insolvent.
Europe is stable because the monetary policy that underlines the economies make it stable. However, growth is anemic. And so my confidence in Europe is simply along the lines of we can buy real estate properties, and offices are occupied. Employment, is trending lower, and people need to live in multifamily apartments and stay in hotels. And so we bought and aggregated a lot of very attractive assets, again, financed at very low rates. But having said that, are there a lot of corporate opportunities at this point in time? No. After Brexit, when October 31st comes and goes, we'll see whether there's more opportunities in the UK. But right now, it's a waiting game and waiting to see that outcome.
It is interesting because you are moving away. You sold a bunch of assets in in Ireland and also in Britain and in Germany, shopping centres in Germany, and you're moving to the peripheral countries, right? Or Italy and Spain?
Italy and Spain and Portugal. We're staying away from Greece and Cyprus and focusing our interests and our acquisitions in Spain, Italy, and Portugal. Very vibrant economies, and Spain is doing quite well. In fact, much better than most of the other countries up north in terms of GDP growth.
Exactly. Hard Brexit had been your base case. Is it now, still?
You know, it's a very tough equation because if you take the man at his word, Boris Johnson, the Prime Minister, just this week, when asked the question in front of a press corps, responded, "I'd rather be dead in a ditch than delay Brexit." And so it's all going to come down to constitutional law. He's been blocked by the Constitution, by the Parliament, from leaving without a deal, and yet he's told the people, and the people have voted that they want to leave, and he stands behind it. So the question is, will he go crashing out with it? And I think the one thing that he may be able to change is that whole Irish backstop, to make it from a backstop to maybe a soft cushion to allow trade to flow, at least initially, until they can resolve that.
What would that soft cushion look like? Some kind of border in the sea? And would Europe agree to that?
I think that it wouldn't be a border in the sea, or it wouldn't be a border, within the country initially, and they'll let goods flow, and there'll be a soft stamp on it, and an expedited process for it. And so it'll be a softer process. And I think that's behind the scenes what he's trying to negotiate. And if he can negotiate that, I think he has greater confidence in saying, okay, October 31st, we are indeed leaving. And so until then, it's a waiting game. There's too much uncertainty to invest for us, but we stand ready based upon outcomes.
That wouldn't be a hard Brexit then, let's just clarify that.
It's a soft Brexit. It's a hard Brexit. You can call it whatever you want, but if on October 31st they leave without a real cooperation from Parliament and without a substantial deal long term from the EU, I would call that a hard Brexit, but with some caveats or some cushion to that.
If there is eventually a resolution, at least something this year, would you then be interested in going back into Britain? What would make Britain attractive to you again?
Well, two things. Number one, if there's further distress that happens as a result of a Brexit, then we'd be interested at much cheaper prices. Or alternatively, if the economic environment were clarified, it would make it investable again.
Let's talk a little bit about the US. Does what happened today change any equation for the Fed? What does the Fed do? Where does US growth end up the year?
The more that trillions and trillions trade negative, and today that number is 17 trillion, the more there's a hunger game going on around the world to buy US credit assets. High yield, leveraged loans, structured credit, and even emerging market debt. And so there's enormous buying demand coming from around the globe because the currency swap rates have also compressed a bit, making it more attractive to buy U.S. assets. And so all this does is feed further into a lower rate regime here in the U.S. and a further bid or demand for corporate credit and alternative credit that offers attractive rates of return.
Should we be concerned about that? I mean, clearly you wouldn't be so concerned about that, right? That would be your area. But should the rest of us be?
Well, I think there is reason to concern because, some of these recession signs are starting to flash red. And specifically, we're talking about the 16% decline between U.S. and China trade, despite toning down the rhetoric and agreeing with Xi and Trump to open up discussions again. The fact of the matter is trade is falling, and companies and countries are making adjustments as a result. So trade is weighing, number one. Number two, we saw PMI numbers as well as ISM numbers decline, and it's now below 50% at 49.1, which is a flashing sign for recession. Number three, the yield curve has turned negative, and 6 out of the last 6 times when two-year notes versus 10-year treasuries and the 3-month bills versus 10 years turn negative, there's been a recession ensuing within a year and a half period of time. And finally, the Fed's recessionary indicators are starting to trend up to a point where it's at a point where every time it's been at this point in the last 5 cycles, a recession has ensued within a year to year and a half. So we think that the base case is actually 50-50 whether there's a recession or not, but the base case is a continued slowing from 3% GDP last year to 2% today to 1% next year.
What happens? You had said the cycle would turn in 2020, but now that red flags are becoming more obvious, do you pull that forward a little bit?
No, I think our time frame is, a year out. Marathon is very engaged in, being patient, waiting for a trigger point in the marketplace, which is much wider credit spreads, which is dollar prices trading, below 70 and 80, and which is higher default rates in order to deploy what is our dry powder for buying distressed.
Well,
so discipline and patience is key.
Very good. Let's talk about what might be that catalyst then. We just had a downgrade of Ford to junk, obviously. Is that a harbinger potentially of a turn in the cycle?
Well,
Fallen angels were down to about 20 billion in 2017. So.
I think you just said it. I mean, when's the last time you remember one of the big three auto manufacturers in the U.S. falling from investment grade to junk? Do you remember that? 2008, yes,
yeah,
correct.
9, I was going to say. Yep.
And so, yes, that is a indication. But the bigger picture for triple Bs is here's Ford Motor Credit, $157 billion in debt that just fell to junk. Now Moody's rates it junk, but S&P still has it IG. When S&P moves it to junk as well, and both rating agencies have it there, then we think there's a lot of IG holders and mutual funds that have to sell, and we think the prices get even cheaper. But today you can buy a Ford Motor Credit 5-year note at around par, and that's not a bad yield for what we consider to be a strong double B.
Are you buying them?
No, because we're waiting for the next rating agency to downgrade, prices to go lower, and then 2 fistfuls we're buying them. So the bigger picture, though, is the triple B bubble. And we wrote a white paper on this recently about the proliferation of triple B issuance. So what you notice when the Fed lowered rates for the first time in 11 years, just over the summer, it was the first time they lowered rates in 11 years, that there was a proliferation as soon as Labor Day was over in corporate bond issuance. There were 70 issuers that just flooded the market.
Yep.
Because what this stimulates, again, lower rates, is not aggregate demand, but it stimulates corporate issuance or further debt in the system. And so in 2008, there was 750 billion of triple Bs. Today, there's 3.1 trillion. Fourfold increase in what's essentially a decade is unprecedented.
Right, and even in the last few months, there have been changes. So what sectors and what companies are you?
It's the consumer sector is the number one, consumer products, consumer sector, number one most vulnerable of the IG companies. And we talked about, I think, Heinz Kraft and some others last time I was on the show. But here's the point. Out of that 3.1 trillion triple Bs, 300 billion today has a debt to EBITDA ratio that exceeds 5. 5 is the average debt to EBITDA ratio for a single B plus. Those bonds should be rated junk. So what do I think? I think there's another 300 billion kind of almost guaranteed that when the economy really does soften, when earnings do soften considerably, which it will, that will fall from IG to junk, presenting folks like Marathon with a tremendous buying opportunity.
Mostly consumer department stores, or other areas too?
Yeah, no, it's you look at all the industries, it's across the industries, but a lot of it's consumer products. We mentioned, I think, maybe one of Anheuser-Busch. We mentioned Heinz and others on the last show, and that hasn't changed. We have our names. We have the names of every company that's in the triple B complex, who the most leverage are, and who most vulnerable are according to their business models. And those are the names that we're setting up our basket of shorts in.
Argentina, Bruce, we saw a huge market move, obviously, and I'm curious as to what you did with that.
Currency went down 30%, equities went down 50 to 60%, and bonds got cut in half from prices of like 80 to 40. And so you've never had currencies drop by more than 20 when the equity market dropped by 50%, that a recession didn't ensue. And so when the transition happens from Macri to Fernandez, there's going to be a pretty big opportunity, we think, for us to buy the best equities and the best credit in Argentina. And so we're setting up an entity right now, and we're in the process of that. I can't talk about it live because it's happening live with us and our clients, to go into the marketplace and to buy what we consider to be the best equities, which we think will make a 2 to 3%, 2 to 3 times return, so 2x, 3x return, and debt that we think will make a 50 to 75% return on.
Can you mention any of the companies you're particularly?
I can't because we're in the process of.
You're waiting, though, until the election, even though we saw the massive move on the primary?
We're starting to buy some now, but the biggest buy will happen over the course between now and year end, we believe. And the election is closer to year end, yes.
Other emerging markets? Because the EMBI
The emerging markets are doing really, really well.
Yeah.
Look at the EMBI, the Emerging Market Bond Index. It's up 14.5% year to date.
Yep.
When U.S. Treasury 10-year notes up around 10 and high yields up around 9. It's outperforming the market by 500 basis points. Why? Because although equities are soft in emerging markets, the S&P is up at 20% year to date, and meanwhile, emerging market equities are up about 1 to 2%. It's completely lagging, as are currencies. But why is the debt performing so well in emerging markets? Because it's a debt story. The debt to GDP ratios are like 40 to 50%. Very sound credits. In fact, half of your bonds in the emerging market bond index are actually investment grade. And so they'll do very well. It's an opportunity with the trillions trading negative for investors around the world to buy sovereign debt at really attractive rates of return.
But if we see a global slowdown, or if we see these trade wars not receding but getting worse, does that impact negatively some of these emerging markets?
We think the sovereigns and the debt story is much more solid. It's more about a growth and an equity story that will weigh in the emerging markets. And the reason why the smart money has been buying emerging markets, and we've been buying emerging markets all year long by the fistful, is for that specific reason. The best credits with the least leverage, they're trading at very high yields in a world where we live in the Hunger Games and there's a yield starvation, and that's the trade.